Chapter 4. Legislative Implications for Business Ethics. Companies have many legal requirements with which they must comply. This varies from organization to organization and is typically dependent on the nature and size of the company. This list presented, while not exhaustive, presents many of the more commonly known applicable laws for local organizations. From an ethics perspective, the following acts and laws are particularly important in Trinidad and Tobago. The Companies Act, Chapter 8101. The Integrity in Public Life Act, Chapter 2201, for persons in public life. 3. The Prevention of Corruption Act, Chapter 1111. 4. The Proceeds of Crime Act, Chapter 1127, the Financial Regulations Obligations. 5. The Equal Opportunity Act, 2001. Each of these acts have relevant sections or clauses which address ethical conduct in business. The Integrity in Public Life Act, for example, has a whole section as a code of conduct for persons in public life. In addition to the local legislation identified previously, companies should be mindful of the international laws which affect their operations as well. Similar to local legislation, the applicability of these laws do not pertain to every organization, but is dependent on the nature, size, etc. of the companies. Based on the results of the ECTT mapping survey, for the purposes of this online course on business ethics, we will focus on 3 specific laws of other countries that affect companies in Trinidad and Tobago, since many of these companies have operations or are doing business with organizations within these jurisdictions. These laws are Foreign Corrupt Practices Act, from the United States, September 1977, amended 1998. Corruption of Foreign Public Officials Act, Canada, July 2009. 3. UK Bribery Act, April 2010, enforceable since July 1st, 2011. To determine whether your organization needs to be compliant with these laws, 3 main questions should be answered. To whom in Trinidad and Tobago does it apply? Answer: all foreign listed or registered companies, their local third-party agents, consultants, distributors, or under UK legislation, anyone who performs a service on behalf of an organization, including individuals. Question 2. What causes an offense? Answer: generally speaking, giving bribes, directly or indirectly, under UK legislation, also receiving a bribe. Question 3. How is this related to corporate governance for organizations? Understanding your own risks and that of partners, preparing proactively by being able to share information that would be required in third-party due diligence process, and being prepared to ask the same questions of your own partners. If your organization falls within any of the categories mentioned here, you are legally required to adhere to these laws. In the following pages, we provide further detail on these laws and provide a comparative analysis of each. The comparison takes into consideration the applicable section or provision of each legislation document and provides a brief analysis of its intention and applicability to the organization. Each area directly or indirectly impacts the manner in which business ethics is managed within your organization. Who is being bribed? Only bribes paid or offered to foreign public officials are prohibited. In Canada, only bribes paid or offered to foreign public officials are prohibited. In the UK, prohibits bribes paid to any person to induce them to act, including private individuals and companies. Prohibits payments intended to influence persons in their capacity as FPOs to obtain or retain business. Nature of advantage obtained. In the US, payments are made to obtain or retain business. In Canada, payments are made to obtain or retain an advantage in the course of business. in the UK focuses on improper action rather than business reason. Nature of bribe. In the US, only the act of paying or offering to pay the bribe rather than receipt or acceptance is prohibited. In Canada, only the act of paying or offering to pay the bribe rather than receipt or acceptance is prohibited. In the UK, prohibits both the payment, offer to pay, and or receipt of bribes. And fines and penalties. In the US, both civil and criminal proceedings. Bribery for individuals up to 5 years imprisonment, and fines up to $250,000 for entities up to $2 million. Books and records internal control violations, individuals up to 20 years imprisonment and fines up to $5 million. For entities, fines up to $25 million. In Canada, criminal proceedings only, imprisonment of up to 5 years and unlimited potential fines. In the UK, criminal proceedings or civil settlement by negotiation with Serious Frauds Office. For individuals, up to 10 years imprisonment and unlimited fines. For entities, potentially unlimited fines. And finally, companies banned from working with EU public entities. Anti-corruption legislation comparison. Personal liability. In the US, strict liability only under accounting provisions for public companies, failure to maintain adequate systems of internal controls. In Canada, does not specifically address personal liability. In the UK, strict liability of corporate offence for failure of a commercial organisation to prevent bribery. Directors and senior executives will be personally criminally liable if their organization participated in bribery with their implied or direct consent. Facilitating payments. In the US, provides exceptions to bribes for payment to a foreign official to expedite or secure the performance of a routine government action. In Canada, provides exception to bribes for payments to a foreign official to expedite or secure the performance of a routine government action. In the UK, does not provide for exceptions, includes facilitation payments to speed up routine government actions. Further anti-corruption legislation comparison. Jurisdiction. US companies and citizens. Foreign companies listed on the US Stock Exchange and any person acting while in the US. In Canada, only applies when the bribery has a real and substantial connection to Canada, whether presence, action, or effect in Canada, and the involvement of a Canadian parent or subsidiary is generally sufficient to trigger the application of the Act. In the UK, individuals who are UK nationals or are ordinary residents in the UK, companies that are established in the UK regardless of where the offence takes place, companies that conduct some or part of business in the UK, foreign companies employing UK citizens. Books and records provision in the US requires that companies make and keep books, records, and accounts which in reasonable detail accurately and fairly reflect the transactions and dispositions of the assets of the issuer. Canada does not address accounting issues, and the UK Companies Act legislation requires that companies maintain corporate accounting records that would reveal corruption. In the following, we look at the summary of major differences of the three anti-corruption legislations. 1. There's an accounting provision in the FCPA that requires detailed accounting records be kept and an adequate system of internal accounting controls to be in place. There is no such provision in the UKBA, as it is already covered in the UK Companies Act. There is also no such provision in the CFPOA. 2. Under the FCPA, and the CFPOA, a company can still be held liable for the wrongdoing of an employee, even if there is a strong compliance program in place. Under the UKBA, a strong compliance program can be used as a defense in the event that an associated person commits an offense. 3. The UKBA covers all bribery, not just those that involve public officials. 4. The UKBA makes no exception for facilitating payments or grease payments made to expedite routine governmental actions. 5. The UKBA makes it a corporate offence to fail to prevent bribery. 6. The UKBA makes it an offence not only to give but also to receive a bribe. Agents, consultants, distributors are all third parties. The U.S. Department of Justice and SEC found third parties to be commonly used to conceal the payment of bribes to foreign officials in international business transactions. Risk-based due diligence is particularly important with third parties and will also be considered by DOJ and SEC in assessing the effectiveness of a company's compliance program. Trinidad and Tobago directors need to understand what is involved and work together with their partners. The following are the components of a third-party due diligence assessment: partner relationship, document specifics, reciprocal compliance program. These are explained further in the subsequent slides. We are focusing on enabling companies that are acting as third parties to companies registered or doing business in the US, UK, or Canada to reduce their own risk and that of the companies for whom they are third parties. The board of directors of a company is accountable for ensuring that the organization is working in an ethical, lawful, and professional way. Directors must establish all the limits within which the organization must operate and ensure that anyone who does work for or on behalf of the company is compliant with the limits set by them. In order for a board of directors to be able to fulfill its function, it must 1. Understand its role. 2. Be composed of the appropriate people. 3. Those who undertake the appropriate activities. 4. In the appropriate kind of way. 5. Disclosing the appropriate matters to the right people. 6. And are ensuring that the owner's rights are respected. Even more practically, the BOD must ensure that the company knows its partners and their relative risk profile well, that their own company documents their own processes, particularly in relation to contracts, qualifications, and payments, and that their own company is ready to reciprocate compliance programs of their partners, or that they ask their partners to reciprocate theirs. Partner relationships, qualifications, and red flags. As part of risk-based due diligence, companies should understand the qualifications and associations of its third-party partners, including its business reputation and relationship, if any, with foreign officials. The degree of scrutiny should increase as red flags surface. Ongoing monitoring of relationships. Companies should undertake some form of ongoing monitoring of third-party relationships. Where appropriate, this may include updating due diligence periodically, exercising audit rights, providing periodic training, and requesting annual compliance certifications by the third party. Document specifics. Business rationale, role, contract, payment. Companies should have an understanding of the business rationale for including the third party in the transaction. Among other things, the company should understand the role of and need for the third party, and ensure that the contract terms specifically describe the services to be performed. Additional considerations include payment terms and how those payment terms compare to typical terms in that industry and country, as well as the timing of the third party's introduction to the business. Moreover, companies may want to confirm and document that the third party is actually performing the work for which it is being paid, and that its compensation is commensurate with the work being provided. Reciprocal Compliance Program. In addition to considering a company's due diligence on third parties, DOJ and SEC also assesses whether the company has informed third parties of the company's compliance program and commitment to ethical and lawful business practices, and, where appropriate, whether it has sought assurances from third parties through certifications and otherwise of reciprocal commitments. These can be meaningful ways to mitigate third-party risk. Chapter 5. Guidelines for Compliance. The Department of Commerce's International Trade Administration has published Business Ethics, a manual for managing a responsible business enterprise in emerging market economies. The Department of State has published Fighting Global Corruption, Business Risk Management. Most notably, the OECD's 2009 Anti-Bribery Recommendation and its Annex 2, Good Practice Guidance on Internal Controls, Ethics and Compliance, published in February of 2010, were drafted based on consultations with the private sector and civil society and set forth specific good practices for ensuring effective compliance programs and measures for preventing and detecting foreign bribery. In addition, businesses may wish to refer to the following resources: Asia Pacific Economic Cooperation, Anti-Corruption Code of Conduct for Business; International Chamber of Commerce, ICC Rules on Combating Corruption; Transparency International, Business Principles for Countering Bribery; United Nations Global Compact, the 10 Principles; World Bank, Integrity Compliance Guidelines; World Economic Forum, Partnering Against Corruption, Principles for Countering Bribery.